Good evening, everyone. Thank you for joining us, as Celeste said, for our Autumn Budget 2025 reality check, what it means for you. I'm Freddie Barton, part of the advice team here at Flying Colours. So today we're going to be running through what's changed, what hasn't, and what that means for you. As Celeste touched on, please don't act on any of the information contained within this webinar. This is simply for information purposes. Please speak to your advisor or get in touch with us if you do have any specific questions. I do want to start, however, today with a poll to kick things off. So I'm going to bring up the poll on the screen now, if you bear with me and the tech allows. So this poll is, I'd like you to describe the autumn budget this year in one word. So hopefully that's come up on your screen now. Your options are fair, unfair, confusing, shambolic, and unrealistic. I'm already getting quite a few answers to one particular description there. I'll give it a couple more seconds before ending this poll. Okay, I think that's probably most people answered there. So I'll share those results with you. As you can see, the majority of your 60% on the call have described it as shambolic. Second is unfair, and then a sort of a tie between confusing and fair, with some thinking unrealistic. So I'd actually tend to agree with the shambolic nature of this budget. It's the first time the OBR have released the budget information prior to the Chancellor actually standing up and going through it. So I'd agree with that, and certainly there's been some questionable changes within the budget, which we will go through today. So very much with you on the call, very much more a shambolic budget this time around. What we're going to cover today is the economic and fiscal context, the sort of broad, big picture of what's going on to the country as a whole. Then we'll look a bit more at personal tax changes and pension and national insurance contribution reforms and how that's hitting your pocket directly, as well as the big changes on savings, investments, and property tax. Before finally looking at estate planning, those who are interested in inheritance tax and things like that. That has been a big talking point since last year's budget, so we will be touching on that as well. Before finally looking at opportunities, what can you actually do with your money, with what is still available, given these changes, to mitigate any potential tax or just keep more of what you're earning. So we'll look at opportunities and what you can be doing moving forward and being proactive with your money. So start with the big picture, the economic context. What does this look like? So on the left, you'll see a chart about the titled bank rate. So the Bank of England base rate currently sits about 4%. We've had an increase since the days of cheap money a few years ago. And as you can see, the forecast shows that it might come down a little bit next year before actually creeping back up to maybe over 4%. But what we're looking at there is really we will see the Bank of England base rate potentially and likely level off around the current 4% rate. So they will be sticky around this rate at the moment. That will feed through to mortgages. So I don't expect any big reductions in mortgage rates. They're likely to sit between 4 or 5% for at least the short to medium term. Now, gilts, government debt, they have to remain competitive in an environment where interest rates are quite high. Ultimately, what you can get in a standard cash account, gilts have got to keep competitive with that. So the yield, the return that you get on long-term gilts, the sort of 20+ year gilts, have been forecasted to rise and will continue to rise. Now, the effect of this is it means the government borrowing cost is going to be pushed up. This means the debt servicing takes up a bigger share of our public spending. In fact, the OBR have estimated that this year, 25-26, our debt interest bill, so just the interest that we're paying on our debt, will be 111 billion. That is about 8.3% of total public spending, or just over 3% of our national income. And sort of touching on national income, what we've seen in this budget is a 2.1% tax to GDP. So GDP being our total national output, we've seen a 2% rise in our tax to GDP ratio. But more interestingly, if you look at the inherited tax system, the forecasted changes, as well as the inherited tax system and the new changes introduced last week, from the start of this decade up to the end, we are forecasting about a 5.4% total increase in tax to GDP. So as a share of national output, we are all paying a lot more tax. So unlike the roaring 20s, very much the taxation 20s this time around. Now, second order effects of this is likely going to be inflation will remain sticky. Currently, it's 3.7%, which is about 1.7% over the Bank of England's targets. Now, with the government debt servicing costs going up, welfare costs going up, it's likely they're going to be back for more tax rises in this parliament. That will likely trickle down into prices, whether it's through businesses or whatever else. We are likely to see inflation remaining sticky because of this difficult economic backdrop that we are experiencing. So overall, unfortunately, not the most positive economic backdrop, although that 4 to 5% mortgage rate is very much in line with long-term averages. I'm sure many of you on the call will have experienced much higher interest rates than the current 4 to 5%. It is very much in line with the long-term average, but overall, not the best economic backdrop that we are living in at the moment. How does it affect you, though? That's the most important thing, really. The first change that we've seen in this budget is simply the extension of the personal tax thresholds. So that is the personal allowance, higher rate threshold, and additional rate threshold for income tax, and the national insurance contributions primary threshold. They've all been frozen at their current rates. Now, actually, this was introduced by the Conservative government in response to the COVID-19 pandemic. And this is, as you've probably seen in the financial press, very much stealth tax by the back door. Ultimately, this is one of the biggest revenue earners for the government of the last few years, and definitely over the next few years. And I wanted to illustrate, how big this policy is, because I think most people, you don't miss the money you've never earned anyway. So I wanted to illustrate, the effect of this if this at all never happens. So what we're going to do is another poll, and this time we're going to take a stab at what the higher rate tax threshold, being currently 50,270, what would that be if it had risen with inflation throughout this whole decade, so up to 2030-31, where would that 50,000 higher rate tax threshold sit by the time we get to the end of the decade, should it have been uprated every year with inflation? So let's give it a few more seconds. We're very 50-50 in answers, so I'd like to see a few more coming through if possible. Okay, we'll leave it there. Oh, we've got a couple more coming in. I'll give it 3 more seconds. 2, 1. Okay. So most of you thinking 70,000 plus, although a big proportion of you thinking 80,000 plus. Now, the reality is those who have answered 70,000 would be absolutely right. So if the policy had never been introduced and we weren't living in this tax threshold freeze environment, you could be earning £70,000 a year by the end of the decade and not pay a penny in higher rate tax. So to give you an example on this, if you do earn £70,000, by the end of the decade, you would be paying roughly £4,000 or more extra in tax. It's an additional 20% on that £20,000 between 50 and 70,000. So it is significant, but it is through the back door, because as mentioned, you don't miss what you've never had. The impact of this policy, this ongoing fiscal drag, means that more and more people are going to be pulled into these higher rate and additional rate tax thresholds. And in fact, the OBR forecasted that by the end of the decade, in comparison to 2021-22, there's going to be 15% more people paying higher rate and additional rate tax. So a very, very big increase in the amount of people paying these higher rates than otherwise would have been should this not have been introduced. And just to show you how effective of a policy this is for the government, this gives you an insight into all of the changes that were, or most of them that were introduced last week, forecasted ahead for the next few years, as you can see by the colours. The fiscal creep, this freeze in the thresholds, is the single largest contributor to the government coffers over the next few years. So it is significant. It's the biggest thing that they can, it's the biggest lever they can pull on. They have backed themselves into a bit of a corner, given that they've promised not to increase the rates of income tax, national insurance, and VAT. So all they can really do is freeze the thresholds and let inflation do the work. And let me tell you, as you've seen, it has been doing the work. How do we respond to this? Now, the bad news is there isn't a huge amount you can do. Ultimately, if you're employed, your money is going to come through PAYE. You've got to earn money to live. So you are paying the tax. There's not an awful lot you can do. If you're a business owner, you might have more flexibility, but there are some practical areas that you can consider sort of across the board to mitigate tax as and when you can. First and most simply, ISA allowances. Use yours, use your partners. If you've got the ability to do, start using your junior ISAs, the kids, start that gifting strategy, start thinking about how you can mix tax mitigation with excess capital, with estate planning, passing it on to the next generation. As mentioned, manage timing of income where possible. If you're employed, you might be quite limited here. Maybe you can speak to your employer about timing of bonuses, spreading these around, anything you can do there. Now, for business owners, company directors, you are in a much better position. You can maximize those legitimate deductions and sit down with your accountant and your financial planner to plan the extraction of your income, mixing in, dividends, salary, spousal allowances if you have a spouse as well that you can use allowances for, and pension contributions as well. Whether you're employed, company director, pensions still remain one of the most favourable tax relief investment vehicles that you have available to you. We're going to touch on this in a minute, and you've got a window of opportunity before we see some changes in this pension area by April 2029. So touching on pensions and salary sacrifice reform, wanted to clarify this point very quickly. I mentioned April 2029. Another thing that's been introduced, and probably the second most contentious policy announcement this time around, is salary sacrifice changes. Salary sacrifice, just to put some context on this, it's where a portion of your gross, as in pre-tax salary, is paid into your pension before it makes its way through the tax system. So you're only taxed on what you don't sacrifice. So, for example, you've got Celeste on the call. She earns £100,000 a year. She may sacrifice £10,000 a year. So really, she's only taxed on the £90,000. The announcement that's been given last week is that from April 2029, any pension contributions via salary sacrifice above a threshold of £2,000 a year will lose their national insurance contribution exemption. So at the moment, that £10,000 Celeste is putting into her pension, the full amount gets, of course, tax relief at 40% because she's not paying that 40%, but also she's saving 2% national insurance at a high rate. Taxpayer. So it's been extremely generous, but that is going to be capped from now on. So, above £2,000 a year, poor Celeste, that £8,000 above that threshold, is now going to be liable to national insurance contributions for her personally, but also for the business as well. I want to highlight here that ordinary employer contributions remain exempt. So if Celeste's employer is also paying 10% a year separately to this, that will not be included in this regime. They will remain exempt from the NI insurance. It's simply just what Celeste is doing via salary sacrifice. So who is most affected by this? You'd probably think higher earners, though with very, very high income. Actually, it's employers again. It's the second budget that we're seeing employers hit with more tax. And in this example, poor flying colours, they're going to have to pay 15% on the excess, which in this example is £8,000, for Celeste. That's £1,200 for flying colours to pay in employer national insurance contributions if Celeste did not change her salary sacrifice strategy. Celeste pays an extra £160 a year. She's still not happy about it. I can see you frowning there, Celeste. You're still not happy. But the employer is certainly taking the biggest hit with this. You extrapolate that across big businesses. Yet again, it's businesses taking the hit on this. Now, almost ironically, the second most affected by this is lower earners, basic rate taxpayers, because they pay national insurance at 8%. Remember, if you cross the 50,000 threshold, any earnings thereafter are at 2% national insurance contributions, like we've seen in that example, Celeste. If poor little me, making £50,000 a year, for example, was contributing the same as Celeste, £10,000 a year, my excess, again, £8,000, is going to be taxed at 8%, 4 times more than Celeste. So in this example, I'll be paying an extra £640 a year. Celeste is laughing all the way to the bank. She's only paying an extra £160. Flying colours are crying in the corner, paying an extra £1,200. So yeah, employers and lower earners, almost ironically, are paying the brunt of this. Higher earners are relatively less affected. So second order effect here, at the moment, it's quite common for employers to pay the savings that they make because their employees are utilising salary sacrifice, so they're saving national insurance when they do that. It's not uncommon for employers to contribute that into their employees' pension schemes. We're likely going to see that stop in a lot of cases. Employees are being hit by, increases in, dividend tax for the owners, minimum wage increases, and all these other things. It's likely we're going to see some of this passed on, or a lot of this passed on to the employees through their pensions, which unfortunately is not a very good thing. Now, there were a lot of speculation and rumours on pensions this year, almost very frustratingly, and he says begrudgingly. So I want to clarify what hasn't changed, to be very, very clear, because pensions are still an excellent vehicle for those across the board, across the tax system, whether you're a higher additional rate or basic rate taxpayer. So there's been no major changes this year in the annual allowance. That remains at £60,000 a year, providing you have the pensionable earnings to do that. The big one is the pension commencement lump sum. You probably all heard that this was going to be capped. We heard 50,000, we heard 100,000. People were rushing to get this out of their pensions. We saw billions this year released and withdrawn from pensions, not with flying colours clients, don't worry. This is across the UK, of course. But this has not changed. And unfortunately, this rumour was left to simmer for quite a while, causing a lot of people to take this out. And ultimately, that can't be reversed. But that benefit is still there, which is good. Now, I was quite surprised by this. The higher and additional rate tax relief system, currently for 40 and 45% taxpayers, whatever you pay into your pension, you can get up to 40, 45% tax relief if you've got the earnings to do so. This is a big cost for the government, actually. And considering it hits the higher earners, the people that you think the Labour government would go for, this has been retained, in favour of the salary sacrifice regime. Whether that's what they meant to do is yet to be seen, but that's been retained, which is good news. And there's been no move to a flat rate tax relief system, which was rumoured to be introduced. I really thought that was going to come in. So all of this is good news for long-term planners. However, let's remember, we have a few more years left of this government. So these benefits are excellent. They've been retained, and you should be speaking with your advisor now to make sure you're utilising them to the best of your ability, because we don't know if they're going to come back for more. Because over the last 2 years, there's been 2 successive budgets with 2 seismic changes in pensions. The first being pensions in the estate for inheritance tax. So from April 2027, anyone with a private pension, whether it's 100,000 or a million, that is going to be included in your estate when calculating inheritance tax on your death. And this is alongside the frozen thresholds for inheritance tax as well, which I will be touching on, as well as this year with salary sacrifice being restricted. So they're being brought into the estate, and the amount that you can do through your salary sacrifice regime tax efficiently is being curtailed. Now, It is interesting the timing of the salary sacrifice change, April 2029, that's election year. So whether this was just something to balance the books on paper that may not materialize, that is yet to be seen, but we have to plan for it anyway. And what you can see at the bottom there is just an illustrative example of employers versus the effect for employees, given this salary sacrifice change. But two very big changes. And this is why I highlight that they may come back for some of these other excellent benefits that have been retained. So make use of them, speak to your accountant, your advisor, and see if you are making the most of the allowances and reliefs still available to you at the moment. So I touched on estate planning a second ago, the nil rate bands for inheritance tax. So I want to touch on this area because it is a hot topic. There hasn't been a huge amount of changes. The inheritance tax thresholds alongside the personal tax thresholds have remained frozen or will remain frozen until 2031. That's your 325,000 nil rate band and your 175,000 residential nil rate band. Now, all being equal, a married couple with kids and a main residence could pass up to £1 million tax-free, inheritance tax-free on second death. These allowances actually haven't been increased since 2009, I think, when I checked this. So these have been frozen for a very, very, very long time. So more and more people will be affected by inheritance tax as the years go on, as you can see on the chart below. I touched on the pensions entering to the estate. You can see the big uptick there in the amount of deaths subject to inheritance tax. This is OBR forecasts following this budget. And then that will continue to rise. And in comparison to just 2 years ago, where we had just over 4% of deaths liable to this death tax, you've now got, by the end of the decade, nearly 10% of all deaths will be affected by this. So there has been no changes to gifting exemptions. You can still gift as you were before. If you're not doing that yet, I would implore you, if applicable, to look into it. But in this freeze environment where more and more people are going to be pulled in to paying inheritance tax due to their rising house and asset prices and the freeze in the thresholds, as well as the pensions entering your estate in 2 years, you may be one of these people. And so intentional gifting, utilizing what's available to you, and a long-term estate strategy become ever more important. Of course, you've got to look after your own needs, make sure you have enough to live an independent and dignified retirement and afford care home fees if applicable. But beyond that, sit with your advisor and plan how you can pass on as much to the next generation whilst you've still got the ability to do so before it gets slapped with a big 40% tax on your way out. So plan effectively and keep more of what you have built. But no big changes there. There's been a small trust change, which I won't put you to sleep with tonight because it affects less than 1% of you. Now, a big area from this budget was the investment, savings and property tax changes. What's changed here, firstly, is dividends tax are increasing from April 2026. Yet again, another hit for directors, business owners, entrepreneurs. So the basic and higher rate are increasing. They've not increased the additional rate. I don't know why. They've just decided to leave it. They are increasing. So again, this just triggers yet again another reason for you to sit down with your accountant and your advisor and look at how you are planning to extract income over the next couple of years and beyond. Is there anything more or anything different that you could be doing now? Are you utilizing all the allowances for you and potentially a partner? Are you utilizing pension contributions effectively to keep more of that revenue and keep more of what your business is generating? Savings and property income tax are another big change in this budget. From April 2027, we see all the rates, basic, higher and additional, pulled up by 2%, so 22, 42 and 47. So this affects anyone who receives interest on their cash. If you're a higher rate taxpayer, after £500 interest in one tax year, you're liable for tax on the rest of it at 42%. And at current interest rates at 4%, you only need about 12.5 grand to generate this outside of ISAs and whatnot. So if you have got quite a lot of cash generating interest, maybe you are declaring it, maybe you've forgotten, maybe you should do that, then this is going to affect you. Rental income, the same. So those who are buy-to-let property owners, some of the forms of passive income from property, your tax is also going up. And again, almost ironically, whilst they're going for people who've probably got the broadest shoulders, is what they would say, the impact, who this will directly impact as it trickles down the economy, is renters. Because ultimately, you put tax up on landlords, they'll either sell the property because their net yield, the return they're getting from that property after costs, after tax, which is a big cost ultimately. If they're not getting a good yield, they're going to sell that property, which is going to reduce the availability of rental properties and or increase rents. So again, for those of you on the call who are thinking about that estate planning strategy, thinking about your kids, thinking about your grandkids who are in rental accommodation or will be in the future, this will affect them. Rents will go up. There'll be less supply of rental property. So maybe now's a good time for you thinking about how you can utilize what you've built to help them. But ultimately, you need to get advice before you do gift any funds significantly to make sure you are looked after. I do want to touch on one effect that this creates, a bit of a niche investment here that some people may know, be interested in, or want to discuss. It's REITs, which is Real Estate Investment Trust. An investment trust is simply a company that is listed on the stock market, and it's a real estate investment trust. So it's an investment vehicle that invests simply in property, whether commercial, residential. So you can hold a real estate investment trust, much like other funds, to get exposure to property, and it may become something direct property investors consider as an alternative now, given these tax increases, notwithstanding everything that comes with being a landlord. If the tax is just going to go up and up and up, and everyone knows about this renters' rights bill, which is making it ever more difficult to be a landlord, real estate investment trusts may have their part to play. Whilst this environment and tax increases does make it slightly less favourable for them, they do retain some benefits. So indirect property ownership through a collective investment like a REITs not only gives you more diversification, so you can get exposure to multiple properties up and down the country through a collective fund managed by a professional, you can actually hold these type of investments in your tax efficient wrappers, so stocks and shares, ISAs, and pensions, where growth and dividends and interest is all tax free. And so you can really bring down the tax and still have your exposure to property via this type of investment. And also, real estate investment trusts don't pay corporation tax on the rental income before they distribute it to their investors. So given the increases in direct property tax to you, if you own a property, pay to you directly, or even if you incorporate and you own property for a business, that's going to have corp tax and dividends when you finally pay it out, which we've seen has gone up. Maybe REITs are an alternative. So the message here, if you are a property investor, whether existing or thinking about it, maybe look at whether that is the financially best strategy for you, or if there is alternatives that could be better for you. And if you are a saver, you've got a lot of cash, you need to be reviewing that and checking how much you're generating. Are you paying the right amount of tax? And is there more you could be doing to mitigate that tax ultimately? Now, all of this represents a deliberate policy shift to align taxation of investments with income more closely, with employment income. This has been rumoured with capital gains tax being equalised with income tax and whatnot. So this is what this policy is setting out to do. Though investment income still does avoid national insurance, this 2% rise is sort of trying to align it with employment income. Whether you agree with that, this is not a political webinar, this is a financial webinar. But some would argue that you take a big risk with any type of investment. Employment income is a lot more secure, you have a lot more rights. So whether equalising that is fair for those who clicked unfair at the start of this webinar, you may agree with that, you may disagree with this policy. Now, a more quietly added change I'll quickly touch on is venture capital trusts. A venture capitalist trust is very simply another type of investment vehicle that invests in startups and small, young UK businesses that meet certain criteria. Because they're very high risk, 9 out of every 10 startups fail, you need to be incentivized to make this sort of investment. So previously, there's been 30% tax relief given on this. So as an example, if you invest 100,000 in a VCT, you'll get a £30,000 tax relief, and it's given as a tax reducer. So the key here in this example, you need to have a £30,000 tax liability as a minimum for you to benefit from that full relief in that example. This is being reduced from 30% to 20% from April. Okay, so this will likely reduce the demand for VCTs naturally because you're getting less tax relief, 20%. Maybe people will look at pensions and whatnot as an alternative, or just not bother because it's a higher risk product. Although tax-free growth and dividends have been unchanged, with VCTs, the growth is not liable to capital gains tax. You get dividends, not liable to dividend tax. That's still a good benefit. But with the initial tax relief being significantly reduced, I would be not unsurprised to see a big reduction in people undertaking this sort of investment. As an example, last time this was reduced by 10% in 2006, you saw year on year funds raised by VCTs fall by 65%. So it'd be unsurprising to see similar effects this time around. And ultimately, it just disincentivizes and makes it very difficult for small UK entrepreneurs to raise money and push them to places like the US or other more favorable jurisdictions to start a business. Really makes it easy to get investment. So just on that, actually, VCTs, I want to stipulate we've got 3 months here before the change. So if you were thinking about it, please speak to an advisor before you do, because ultimately, whilst the tax relief and tax benefits are still favorable, they're very high risk products and very complex products. So please take advice before looking into this, and definitely before implementing any new investment into these type of products. Now, they have tinkered with ISAs this time around. This was, again, something that was rumoured in the financial press for a long time prior. Now, the cash ISA allowance has been reduced from 20 to 12,000, but only for people under 66. So you can thank Martin Lewis for that policy, because I've been told he's taking credit. So send him a scathing email for that if you wish. But that's been reduced, and that I think that policy is really trying to get more people investing, younger people investing. I think the government's role is to get more investment in the UK. Likely not going to happen, even if someone chooses to invest rather than put money in cash, which is a big jump. To go from cash ISA to stocks and shares, you're likely going to look at other cash products, but that's what they're trying to do. And it's questionable whether it will trickle into more investment in the UK. But stocks and shares ISA remains at 20,000 for everyone, and in fact across all ISAs, because you've got an array peer-to-peer lending ISAs, cash, stocks and shares, and lifetime ISAs and other types of ISAs too. The total limit remains 20,000 for everyone. So the only change is if you're under 66, you can only put 12,000 in a cash ISA rather than 20. And touching on lifetime ISAs, they've said they are going to scrap this and replace it with a new scheme, which is yet to be announced. So once again, for those of you on the call with kids or grandkids using a lifetime ISA, saving for a property, like Help to Buy, this is going to be fizzled out and introduced with a new scheme. No lifetime ISA is being moved along. Whether the next scheme will be more favourable or less, I believe it's just another reason for you to review whether estate planning for you personally and for the benefit of your beneficiaries, getting them on the property ladder, is beneficial at this time in advance of that change. And they have announced that the overall review of the ISA regime is due. I welcome this. It needs to be simplified. The ISA regime is very complex. It could be a lot simpler. So I do welcome that change, but it's yet to be seen how that will look. Now, time to get your tiny violins out, because the new high value property council tax charge is being introduced in April 2028. So any of you on the call with a property over £2 million, only teasing, by the valuation office, by the way. So the valuation office are going to be responsible for essentially giving out the valuations for who will be liable to this tax. Now, I've worked in finance for a long time now. I've never heard of the valuation office, so I'm going to be really interested to see how they implement this, the reactions to the market. You'll probably see people separating their £2 million plus properties into separate dwellings, doing all weird and wonderful things to try and avoid this. Most interestingly, though, you can see the rates of payment on your screen based on property values. But most interestingly, this is going to increase with inflation. And, whilst you think people with £2 million or more properties can afford this, That's not always the case. You think of someone who's lived in the Southeast in the same house for 50 years, they may be 80 now. They may just be on the state pension and a small, defined benefit pension, maybe from the NHS, maybe 20, 24 grand a year pre-tax income. They can't afford an extra 2.5 to 7,500 pound a year. So we're likely going to see, downsizing, properties being revamped, and like I say, to try and go into separate dwellings. And if this had been introduced in 2020, the prices you see, the costs you see on the screen would be 25% higher. So this is going to increase quite quickly and quite significantly for these people. And more interestingly, the revenue is going to go to the central government, not your local council. So those potholes down the road and your bins being collected on time is not going to be improved from this change. The central government and Westminster are going to get hold of this. Your local council will not benefit whatsoever. I think that's the one thing that I find questionable about this, is that I think local communities should benefit, but hey ho, maybe I'll be Chancellor one day. But this does signal likely future wider council tax reform. I agree with that. The council tax system is still based on the 1990s valuation data. It is pretty outdated, and it could do with a refresh. So I look forward to seeing how that materializes and whether they get this right. But do expect further changes with council tax moving forward. Now, this slide is on succession and initiative, so it is probably more directed to those directors and business owners on the call. However, those of you who are employees, there are things here that do apply to you, and I'll fly through this quickly. So if you do own a business and you're familiar with employee ownership trust, it's essentially a trust that you could dispose the shares of your businesses into for the benefit of your employees. Of course, for employees and productivity, a very, very good thing. So to incentivize this, there has been 100% relief from the capital gains tax that the business owner would otherwise be liable to on a trade sale if they go down the EOT route. This has now been reduced to 50% rather than 100. Now, I'm going to play devil's advocate here because I think this might be a good thing. It does reduce the attractiveness of employee ownership trust disposal routes. But ultimately, this EOT scheme was designed to encourage genuine employee empowerment and business ownership, drive the productivity within that business, and make sure that the owner is securing a sustainable business succession, not to just treat it as a tax haven, which unfortunately you have seen this happen. You've seen business owners use EOT and just sail off into the sunset with their 100% relief and leave the employees to their own devices to work it out, essentially. Now, with a 50% relief, you're likely going to see more purposeful commitment, and this scheme used as it really should have been to empower the organization to continue and grow for the benefit of the employees. Now, business relief, so that's 100% and 50% relief on qualifying assets and shares in your business and other holdings. I won't get into that on this call. Again, it's getting late in the evening. I don't want to send any of you to sleep, but that has not been touched. Although if you do have qualifying assets, businesses, shares, and you want to ask about anything around that, please do get in touch. But there's been no changes around the business relief regime. Limited liability partnerships. There was rumours that she was going to introduce national insurance on these. That's not materialised. I read that the Law Society were a big lobby against this measure. The law sector had a lot of LLP structuring in the partner practices and whatnot. So it would have had a big effect. The Law Society argued that, of course, you've got backlog in the courts anyway, the legal sector struggling. So, and that they're the ones who would have been hit hardest. So good news for LLP owners there. And lastly, EMI scheme. This is the Enterprise Management Incentive Scheme, which is the most tax efficient UK-based option scheme where employees can share in the ownership of the business that they work for in a tax efficient and flexible way. There's favourable capital gains tax treatment on these sort of share options. You get access to something called business asset disposal relief, essentially a reduced rate of tax and relief on the gains you make from the gains in the shares. They've reformed this whole scheme. So at the moment, it's usually for younger, smaller, more nimble businesses. They've expanded this to allow later stages, more capital intensive, large employee. I think it's gone up to maybe 500 employees now, so that more businesses can qualify for this. and replace their complex incentive schemes with, a really good EMI, tax efficient, viable replacement. There's a lot of information on this. If you're a business owner that doesn't have this, give us a call. We're happy to discuss this with you. But looking into this, good news for employees and businesses who are looking to drive productivity in the businesses and give a bit more incentive to their employees where they otherwise wouldn't have qualified. So, planning opportunities. What can we do? What areas can we look at to be reactive to the changes and proactive for the forthcoming changes over the next few years? So I've mentioned this one. Review your pensions before April 2029, especially those who are employed in some capacity. You've still got, after this tax year, 3 full tax years to go until this change takes effect. Though, if you've got the full 60,000 allowance, that's potentially £180,000 you could shovel in via salary sacrifice into pensions before you lose the NI relief over the £2,000 limit. And potentially you could do more than 180 if you've got carry forward, which is unused allowances from previous years. So again, bit complex in the calculations. Please seek advice before doing anything there. But looking at your pensions are still your best friend for especially higher earners and business owners to mitigate tax in the short term and delay it until you are in retirement, where you will most likely pay a lower level and rate of tax. ISAs, I've touched on this. Just make sure you're maximising them for you personally, spouse if applicable, and kids if able to do so. Review your income sources. Where is your income coming from? Can anything be done here? Sit down with your accountant. Look at how you're drawing the salary, the dividends. How much interest are you getting on your savings? Can you do anything more proactive? Can you change anything around here to mitigate tax? Think about your spouse. Bring them into the business. Get them on the books if they're not working, for example. There's things that you can do to make your income structuring more efficient. So sit down with your advisors and review this and see if there's any opportunities. I've spoken about estate planning. Be proactive. Start looking at if you can afford to gift, because those thresholds aren't coming up anytime soon, but your assets are likely still rising. Your property, maybe your pensions, if you're not drawing from them. Let's start gifting them out if you can. Review this with your advisor. Make a plan. Or over and above £1 million, the government are going to take nearly half of it when you die. So it's your beneficiaries, your executors, who are going to have to deal with this if you don't start planning. Property owners, if it's applicable to you, plan for the council tax surcharge. If you feel like that's going to be unaffordable, you can't afford it, you're going to have to plan for a downsize. If you feel like you've got assets you can draw on, make a plan on how you're going to meet this cost. Does it affect your long-term financial forecast, your financial health? Sit down with your advisor and review it. Company owners, there's a lot you can do. Salary and dividend extraction we've touched on. If you're considering an EOT disposal route, look at that with your accountant. Is that still the best route? Are you committed to that route? Really, ultimately it's a commitment and you get the tax relief, but it's there to make sure for the benefit of your employees and to drive that business forward. So don't just use it as a tax haven. And if your business now qualifies, look into EMI. That could be beneficial for both you and the business and your employees as well. DCTs we touched on, you've got until April 2026 to benefit from the 30% income tax relief rate. As mentioned, this is for higher risk investors, people who are comfortable with higher levels of risk. If that's you and you've got spare capital and are considering looking into this, please get advice. Very complex area, needs to be done right, needs to be implemented properly. So please seek advice on that. Now, what we've not touched on so far today is the state pension, which is set to increase in line with the triple lock next year to 12,548. This is only £22 below the personal allowance of 12,570. So this will go over the personal allowance in 2027. Now, whilst those of you who watched Rachel Reeves sit down with Martin Lewis, she said on that interview that there will be no tax return required for recipients of just the state pension, those who do not receive any form of income. And she even went as far to say there'll be no tax applied to them. Now, I see that as unlikely, that no tax will be possible unless they completely revise the personal allowance regime for retirees. The administration burden of implementing that policy may be too costly. So yet to be seen. But if you are due to get the state pension or getting the state pension, that is going to eat up your whole personal allowance by next year should triple lock continue. So a lot of changes. And overall, the message here is we're at the start of this government and parliament. and I do feel like this is just sort of the start. We're in a difficult economic backdrop. Interest rates are sticky. Inflation is sticky. Cost of servicing on debts is going up. Welfare benefits are linked to inflation. They're going up. The state pension is going up. The NHS needs money. So they are likely to come back for more, or potentially will come back for more. So just being proactive, sitting down with accountants, your financial planner, and just reviewing your income, your assets, how they're structured, what the plan is moving forward, and can you be doing anything more or anything differently to keep more of what you're building, keep more of what you're earning, and give less to, whether you agree with it or not, the ways in which the government is using our money. So if you do want a clearer picture of where you stand, you want to speak with someone on a no obligation, free basis, there's a QR code on the screen. This will send you through to our client relationship team, who will match you with an advisor to have just a very informal sit down conversation talking about your situation, how these changes may come to affect you, and if there's anything that we could do to help you and keep more of what you're earning, make more with what you're earning. There'll be no pressure, no vague information provided. So please, this QR code as well, that takes you there as well. Please feel free to book a call with us. We'd be more than happy to have a chat with you. So we're going to go to some questions. I believe we've got quite a few questions submitted.
We do.
Celeste.
Yes, we
Okay.
do. But firstly, thanks so much for the pay rise. That's
Okay.
what just before Christmas. That's absolutely
That's,
wonderful news. Thank you.
I thought I'd be generous today.
Okay, so we had a few questions come in advance of the webinar, and we've got a couple that have come through whilst the webinar's been going ahead. I'd invite you on the call to use the Q&A function if you'd like to carry on submitting questions, and we'll see how many we can get through. But we'll make a start on a question we had in advance. So this person was asking, how can I best turn a lump sum that's currently not doing anything into a monthly income? In this person's situation, they are struggling with health issues, have a dependent child with disabilities. They really don't have a lot of time on their hands to be able to get into this. So, is there something that doesn't need too much effort or energy? What do you think, Buddy?
Okay. Well, firstly, to this person, I'm very sorry to hear about your health issues and looking after an additional needs daughter. I can tell you, I work with clients in similar positions, and I can only send my best wishes to you for you and your family. So, good news and bad news kind of is that, yes, there are, the point of a financial planner, financial advisor is to take the burden of the heavy lifting of investments, the administration of that, and the management of that away from you. All of our clients live very busy lives, from retirees or those in your situation all the way up to business owners. So the income point, yes, if you've got a form of capital just sitting in the bank, they'll most definitely, depending on risk profile and other factors that are personal to you, be ways that you can generate a sustainable income from that. There will be some time commitment for you in the initial setup phase. We need to understand your position very clearly to make sure we advise you properly. But once that's done, working with an advisor ultimately is only going to take some of that administrative burden and expertise as well to take that stress away from you. To, in answer to your question, yes, but we'll need to look at it with your personal circumstances in mind. And I do wish you all the best.
Okay, thanks, Buddy. So the next question is, I want to transfer my pension fund from Aviva to Interactive Investor. Should I take out the 25% tax-free lump sum before the transfer, or wait until the transfer is completed?
I wonder if this question was submitted before they confirmed that the 25% wasn't going to be capped. I'm going to assume that that is not the case, that they've submitted it since. So of course, if it was before, this may be a moot point, but assuming they're informed about that, I don't think it matters ultimately, as long as Aviva and Interactive Investor both facilitate that payment or that withdrawal of your tax-free cash for you. It doesn't really matter which do it. Ultimately, it depends on your time need for the capital. Is it urgent? Because sometimes transfers can take a long time. You've got to disinvest the assets, transfer them across. reinvest the assets, and then take your lump sum, which will have an additional waiting period. I would just stipulate here that I think the gentleman or lady should review whether taking the entire 25% is right at this time. Ultimately, it's an irreversible decision. You can never get this back. Once you've done it, it's done. So you can do partial withdrawals of the 25%. I'm often finding that people hear the 25% and think it's all or nothing. A lot of my clients started working with me on that assumption. What they don't know is that you can take it as a drip feed, whether it's an income, or just take partial withdrawals. So I would implore him or her to review why they're taking it and whether they need the full amount. But ultimately, to answer the question, doesn't matter whether Aviva do it or Interactive Investor.
Great. Okay, so the next question is quite long, so I'm going to summarize a little. But in this instance, this person says their worth is £2.4 million, which includes a home which is worth 950,000, plus buy-to-lets and cash ISAs, which total 1.45 million. They have life policies which total 900k. Both are in trust. They have wills and care fee protection documents in place. The question is there anything else they can do to reduce their IHT exposure?
Well, I'll say all hands to this person. They're very, very switched on with all of this. I think their current situation is excellent. You know, the 900,000 of life cover in trust, that's excellent. If you have got a life policy, you need to make sure it's in trust. Ultimately, that will only make your inheritance tax position worse. And the good news is for this particular individual, that 900,000 more than covers their current liability based on the information provided. The liability will be in the region of, you know, a few £100,000 or more. So that does cover that liability. I suppose a more, you know, bad news for them is that their estate sounds very property heavy. You know, you've got a main residence, and I don't know how much of that 1.45 million is property and how much is cash. Ultimately, cash, yes, look, you can gift that. You know, kids, trusts, whatever it may be, that can be gifted as and when you see fit, and as long as it's in line with a thought out and clear strategy. But if most of it is property, it is a bit difficult. I've got a lot of clients with a lot of property, and you can't gift a door and you can't gift a window as much as some of them may want to. So you really have to plan for how to gift these assets. You know, I'm sure that they're likely living off the income of the buy-to-lets. You know, if they're dependent on that, they need to plan whether, you know, gifting that property would have a big effect on them. So really, it just comes down to, you know, make it looking at whether they've got enough to live the rest of their life with the assets they've got, income and assets. And if so, I would be looking at a form of gifting strategy there, but you'd need to review how property heavy it is. Will it have big effects if they start liquidating property? Can they liquidate the property? So again, it comes down to them personally. But again, well done. They seem like they've done a lot. You've got the liability covered at least. So if you went tomorrow, that is covered. It's in trust. It's all set up for you there. But to bring that liability down, you know, you need to start getting the money out of the estate. Aside from buying a Ferrari or a new Porsche, you've got to look at gifting it ultimately. And I'd be looking at definitely getting it below that 2 million threshold, because that's where you start to lose your residential nil rate band. So the effective liability is getting pushed up post 2 million. So that's a threshold I would certainly try to get back under.
Great. Okay, thank you. So this, I think we have covered this during the call, but probably worth repeating. So the question is, what is the impact of the budget for high rate taxpayers and defined contribution pensions?
Yeah, brilliant. So higher rate taxpayers, as we've seen, it depends where your income is coming from. If you're employed, as we've seen with the higher rate tax threshold, you have been taxed through the back door. You're not missing that additional few £1,000s that you would have got because you've never had it. So really the effect is you've been taxed a lot through the back door over the last few years and will continue to do so. So as an employed person, I would just be looking at how much you need to live, you know, an independent and dignified life as an expense, and line your income with that. If you don't need all your income coming through the PAYE system if you're employed. Utilize salary sacrifice while you still can. You know, that's mitigating that 42% tax that you have as a higher rate taxpayer. Now, and I will assume that they're a higher rate taxpayer based on this, as in employed. With regards to DC pensions, again, it just kind of feeds back into that point of, you know, you're likely to be a basic rate taxpayer in retirement most of the time, most of the clients I work with. So again, pensions are still your best friend because you're getting 40% relief on the way in. And with the 25% of your pot being tax-free and assuming you pay a basic rate level of tax in retirement, your effective tax rate in retirement is more like 15. So 40 on the way in, 15 on the way out. The gap in between is nirvana. That's where you're getting all your benefits. So a higher rate taxpayers, pensions, looking at how much you actually need as an income and aligning your income with that.
Great. Okay. Again, we might have covered this, but the question is, will any other benefit be hit by salary sacrifice? For example, share incentive plan contributions? I'm
really interested in this point actually, and the answer is it's not really it's yet to be seen. I think there's going to be a consultation period on this. At the moment, it just looks like pension contributions, but they're definitely going to have to write something in the legislation to protect people, because I know a lot of clients who pay for their private medical, their life cover, their critical illness, their car through salary sacrifice, and so I would hope and pray that they certainly just keep it at pensions and yeah, not overcomplicate it by applying it across all salary sacrifice arrangements. I thought this exact same thing when it was announced. It looks like it's just pensions. It needs to be confirmed in there in the finance bill and the subsequent consultations. But my answer is I pray that is the case anyway. We're yet to see. And like I mentioned, it's a policy that's due in election year. So whether it actually materializes or is used as a sort of election talking point, that's probably the likely case.
Mm-hmm. Well, that's all the questions, Freddie. So we'll leave it there. Thank you to everyone who's joined us this evening. This is the last webinar of 2025. We will be hosting a number of webinars in 2026, so please do look out for details of those on your emails and in social media. And there will be a recording of this session this evening that will be shared tomorrow as a link. Please do feel free to share that link with friends, family, colleagues who you think will find this useful. And finally, just a reminder again that on the screen there, you've got a QR code which enables you to book a no obligation complimentary session with Freddie or one of our other independent financial advisors here at Flying Colours. And you're very welcome to take up that offer to address any questions or concerns that you may have. So thanks again for joining us and hope to see you again soon. Thank you.
Thank you, everyone.